What are inflation expectations and price spikes? Imagine walking into a store and seeing prices jump suddenly, or hearing that prices might rise steadily over the next few months. These are connected to what people think will happen to prices in the future. That's what we call inflation expectations. Inflation expectations are what consumers, businesses, and investors believe will happen to prices down the line. If people expect prices to go up, they might buy more now to avoid paying more later. Businesses, knowing this, might raise their prices in advance. Workers might ask for higher wages to keep up with the expected increase in living costs. These actions can actually cause prices to rise more quickly, making expectations come true. Central banks, like the Federal Reserve, work hard to keep these expectations steady. They aim for a target inflation rate, usually about 2% each year. When people believe the central bank will stick to this goal, their expectations stay anchored. This helps prevent prices from rising too fast or falling too low. Price spikes are sudden jumps in the cost of goods or services. They often happen because of supply shocks, like a hurricane disrupting oil production or a strike halting factory work. Price spikes can also come from a sudden surge in demand, like during a holiday shopping season. When inflation expectations are stable, these spikes are usually temporary. People don't expect prices to stay high forever, so they don't change their behavior much. But if people start to believe prices will keep rising, these spikes can turn into longer-term inflation. Businesses and workers will adjust prices and wages upward, making inflation stick around. That's why managing expectations is so important. If people think prices will stay stable, they're less likely to react strongly to short-term price changes. Understanding inflation expectations helps explain why prices move the way they do. When expectations are well anchored, inflation stays steady. When they drift away from the target, it can lead to persistent inflation or even deflation. Central banks monitor these expectations closely and use policies to keep them in check. They might raise or lower interest rates or communicate their plans clearly to influence what people expect. In the end, inflation expectations shape how everyone makes decisions about spending, saving, and investing. When these expectations are managed well, prices tend to stay stable, which is good for the economy. Price spikes can be normal, but how people expect prices to behave determines whether those spikes are short-lived or lead to ongoing inflation. Keeping expectations anchored is a key part of maintaining a healthy, predictable economy.